The Federal Reserve has cut rates, but the relief hasn't arrived. The Fed funds rate sits at 3.5% to 3.75%. Inflation is still running at 3.26% above the Fed's 2% target. The average 3-0-year mortgage, 6.4%. The 1-5-year, 5.6%. Americans are still waiting for the pain to end. The reason the Fed won't budge? Inflation. After the worst price surge in 40 years, Jerome Powell is terrified of declaring victory too soon. The ghost of the 1970s haunts every Fed meeting when the central bank cut rates prematurely and inflation came roaring back, triggering a decade of economic pain. But the economy is sending distress signals. Job growth is slowing. Consumer spending is softening. Small businesses are closing at the fastest rate since the pandemic. The cracks are spreading, and the question is whether the Fed will see them before it's too late. Wall Street is betting the Fed blinks first. Traders have priced in rate cuts multiple times this year. Every time the Fed hints at holding, markets sell off. Every time weak data comes in, stocks surge. We've entered a bizarre era where bad economic news is good news for investors, because it means cuts are coming. That's how distorted this moment is. Here's the truth. The Fed has never successfully engineered a soft landing when rates were this high for this long. History says something breaks. The only question is what and when. If you have a mortgage, a retirement account, or a savings account, what happens in the next Fed meeting will affect your financial life directly. This is the most consequential monetary policy moment in a generation, and it's happening right now.